A new Greek Prime Minister is expected to be sworn in Athens today, and a new PM is also expected over the weekend in Italy if austerity measures are approved there. That will cap a week of very significant events, including soaring yields on Italian debt and a revision of Eurozone growth figures by the EU. Joining me on the line to discuss what next week might hold in the financial markets and for currency traders is Head of Research at Accendo Markets in London, Michael van Dulken. Michael, this week has been dominated by Europe and the sovereign debt crisis. Do you see that situation changing at all, and any other story taking precedent? And what do you think the main developments might be next week?
I'd be surprised if the trading focus moved much from the continental sovereign woes. I mean, sentiment's likely to continue to seesaw. We've had the eventual announcement that Lucas Papademos has replaced George Papandreou's Greek PM. So at least that country can move on a little in the political sense, although the delays in the announcement suggest a bit of disagreement between the main political figures, which could resurface as we move towards elections next year. But at least it can now go on to approve the second bailout and get hold of that much needed next tranche of cash. So maybe it can draw a line under its woes for a short time at least. Obviously, we've had the move into Italy, which looks like we're headed towards Mario Monti taking the helm. That may well improve confidence quite a bit, certainly in the debt markets, which responded quite sharply with a surge in yields and then margin hikes, which again led to another surge in yields. So those yields not far off that 7% level, which is akin with prior defaults. A little bit worrying. However, they did manage to sell 5 billion of one-year bonds yesterday, but only thanks to ECB intervention, and the future auction on Monday for 5 years. That'll definitely be much watched. In terms of other stories that could drive the markets, I mean, Europe's seldom failed to please with its twists and turns, so I wouldn't discount anything, to be honest. But after Italy, we've now worryingly moved on to potentially France. We had the S&P error yesterday, which didn't help things, but France's banking sector definitely exposed to Greece, and then I'd be very surprised if it wasn't pretty much exposed to Italy as well. So there could be problems there, not far off, or into the year end.
The EU drastically cut their growth forecast for 2012 this week to 0.5%. Do you expect any surprises from the Eurozone GDP figures due out, and are they likely to increase calls for some form of two-speed Eurozone?
Well, we've had some shocking industrial production figures this week. We saw Germany, France and Italy all disappointed, and then that just was on the back of the prior week's terrible PMI figures as well. So the tail end of Q3 was obviously tough, and so is the beginning of Q4. So it doesn't really bode well for growth at the moment, and may well, I think, translate into another flattish figure for the region. And to be honest, it supports Draghi's comments last week about potentially a mild recession by the year end. So we didn't really get a major reaction yesterday to the EU's cuts in growth. I think the market's pretty much factored that in. In terms of the two-speed argument, I mean, there's been a lot of talk about, do we just ditch X, Y or Z? There's obviously a big divide in the Eurozone growth levels. However, any official division will probably do more harm than good. I mean, I was reminded recently that, we shouldn't forget that without the periphery, Europe and the euro would likely be a lot stronger, which would actually be harmful to Europe's exporters, such as Germany.
Finally, Mike, attention has been drawn away from the UK in recent weeks. Jobless figures and inflation data are due out there next week. Should we be watching the UK economy more closely?
I mean, the UK is part of Europe, so whatever's happening in Europe is going to have an effect. Unemployment is a key figure for any economy and its currency, and while this remains, stubbornly high, as it is in the US, it's going to be a big focus for sterling traders. On the inflation front, I'd be very surprised if that had moved much from its elevated, 5% plus levels, given that commodity prices remain where they are. Other data that could move sterling or affect the UK markets next week would be the nationwide consumer confidence. Unlikely that's got back above the 50% kind of growth mark. Retail sales is also a good figure in terms of consumer sentiment. But really, as I said at the beginning, UK is still kind of part of Europe, and Europe remains the overriding driver for sentiment for the moment.
That's all we have time for, but thank you for joining us, Mike. You can keep up to date with the latest developments next week, as well as getting more exclusive insight by staying tuned to Dukascopy TV. Goodbye.